Let's get a closer look at Q1 in a CNBC exclusive with Kevin Blair, the CEO of Synovus. Kevin, welcome back. It's good to have you.
Great to be with you, Carl. Thanks for having me.
Can you characterize the stability of deposits? And in your mind, is it the most important number right now?
Well, I think it is coming out of this last 45 days. Everyone wondered what would happen with the idiosyncratic failure of these three institutions. How would that translate over into the regional bank sector? And I think our second quarter really proved that if you're a relationship bank that deals with Main Street and you have long tenured relationships with your clients, that you're not only going to not lose deposits, but you can actually grow deposits. We, during the first quarter, saw record deposit production. We saw overall deposit growth of roughly 2%. And I would just point to the fact that when you look at our overall average tenure of our deposit account, it's about 18 years. So these are long-standing relationships. And of course, with all of the anxiety and uncertainty that was created, there were lots of conversations with clients asking the question, what's going on? But once we had those conversations and explained how different we were from what those failed institutions had happened to them with more of a homogeneous deposit base, everyone felt very comfortable with the safety of their liquidity. So I think our numbers really point to the granularity and the success of our relationship-based model.
Right. And now, we've had some players say, yeah, we got some new deposits. We don't expect them necessarily to be sticky, quote unquote. How much are you counting on them to stick around?
Well, there was a little bit in this quarter that you wanted to make sure that you had excess liquidity, and so you may have gone out and originated some CD promotions or taken on some broker deposits. And so, there's a little bit of that. But I think in large part, the $3 billion that we brought on this quarter were all core deposit growth. And so whether it's a 6-month CD or 12-month CD or a new money market account, it gives us the opportunity to take that relationship and to continue to broaden it and improve our share of wallet by selling additional solutions. And that's what's going to keep them on our balance sheet, not necessarily what rate you paid, but ultimately what sort of services and what sort of advice you can provide that client that wants to make them continue to bank with Synovus.
So, Kevin, if I'm a consumer client of yours or a small business client, how much harder is it to get a loan right now?
You know, I don't think it's harder. I think our credit policies haven't changed substantially. What we've actually seen is that our pipelines have diminished because of the demand from our clients. There's just less demand for loans based on interest rates and based on the CRE market, cap rates. And so there's lower demand. But we really haven't changed our underlying credit policies. We made some tweaks and adjustments in areas where we rely on the underlying value of a piece of collateral that may have greater volatility. But our policies haven't changed. What we're probably more attuned to is, can we today make a loan to a client that meets our minimum hurdle? And ultimately, we're requiring that when you come to us, that we want to make sure that we're getting a full relationship, that it's not a loan-only relationship that we have. So we want to have your core deposits come with it or other ancillary services.
So I guess, what does that say, and how would you characterize the state of small business in your area right now?
Well, you know, it's still it's strong. From a credit standpoint, we haven't seen any deterioration on the small business side. Ultimately, demand is lower because as we survey our clients, and we do it every quarter, this is the first quarter that we've had in the last 4 quarters where the outlook for future growth was a bit muted. So I think there's a prudence that's being provided by a lot of these small businesses. Obviously, they don't have balance sheets that allow them to have additional cushions of protection. And so they're prudently looking into the future, worried that demand may subside a bit, and so they're less likely to go out and take on a new project. But the underlying borrower base and the quality of the credits that we see in that small business area are still at historically low levels in terms of just having great credit.